Welcome to this course on CMT Level 1 updates for the 2021 syllabus. So we have 7 topics, 7 broad areas for this exam, out of which some of them have changed this year. So we are going to look at only the parts which have changed. We'll start with section 2, which is charts, trends and patterns. So let's start with this section first, and I will be using some charts to explain the concepts. Some of them are for academic understanding, some of them are just a drawing, simply just few lines to understand them. But we'll also use some live examples. So we'll take some case studies, some examples, some real life cases from the indices live right now, right? So we'll take some cases. I will not reveal the name of them just yet, but we will take these cases and try to see where the patterns are coming from, how the volumes are trending, and we'll try to understand the academic concepts based on the live examples. So let's get started. Before we start with the actual topics, actual syllabus, I would like to cover some basics. Now, trends or charts is basically, as some people, some thought leaders would call it, being able to recognize the patterns in nature, right? Patterns around us is the real test of intelligence. So the pattern in which the bees circle the flowers, or the pattern in which they make beehives, the patterns in which petals of a flower are arranged around the core, or the stars and their shapes and patterns, recognizing them is really a sign of intelligent life. Now, you would know intelligence has many dimensions: emotional intelligence and psychological intelligence, spatial intelligence for hand-eye coordination and so on. So recognizing pattern in all sense is a test of intelligence, and more important is extrapolating them to solve the problems, right? Real life problems. Now this is what we are going to rely on, and the course here is basically to train you on recognizing pattern and making better use of them from the financial markets perspective, from the stocks, indexes, commodities perspective, right? So that is what we're going to do. This is the training for us to recognize the pattern. So that would tell us, that should probably tell you what is the level of importance that we're going to attribute to this course and this training. The father of technical analysis, as they call it, was Charles Dow. And if this name sounds familiar, this name Dow sounds familiar, this is the same person who came up with this Dow Jones Industrial Average, DJIA. There are 30 stocks in it, and it's one of the oldest indices for financial market stocks in US. So obviously that person has done a lot more work. One of his more recognizable and more attributable work is technical analysis, and we have to remember that the work that he did was back in 1930s, right? That time we did not have computers, we did not have sophisticated data collection mechanisms. We had something like ticker tapes, right? We had physical papers. The shares were traded in physical certificates form, share certificates as they were called. The prices would come out only periodically. In many cases the prices would come out at the end of the day. So figuring out the technical analysis, or rather conceptualizing technical analysis and patterns when you had to draw prices by hand, when not only the charts and trends but also the price movements, the candlesticks that we so commonly use now, the graphs of chart movement, they had to be drawn by paper. And coming up with technical analysis during that time was really commendable. So we should give some credit to this discovery back in 1930s. Now the problem with technical analysis is that recognizing patterns, or the rules in which the patterns are formed, is not very difficult. You follow certain rules related to volume, related to shape, related to price movements, and technical analysis is really not that difficult. The rules are not very difficult to understand, difficulty arises from their application. First is an application in a profitable way, moreover. First is the patterns are dynamic. So you can always find patterns in the hindsight, in retrospect, but to benefit from them, to profit from finding these patterns, you have to be very, very peculiar. You have to have very minute eye and very attention to minute details. So only then you will recognize that a pattern is being formed. That comes with practice. There are hundreds of chart patterns that arise. Of course, not all of them are equally important or equally common or equally profitable, but there are tons and tons of patterns, and moreover there are many multiple variations of these patterns. So you might have heard patterns like head and shoulders. There are variations of head and shoulders, double head, triple shoulder, and so on. Recognizing them is a big task, and moreover getting the recognition right and getting into a trade that will help you profit is even more difficult than just recognizing the pattern for technical analysis. The other side to that is, because it is so difficult, because pattern recognition is not something that you can code simply with programming languages. Even with the advanced programming language like Python or machine learning techniques or artificial intelligence techniques, we have developed artificial intelligence techniques which can steer cars on street, self-driving autonomous cars. They can steer a vehicle on the street at a very considerably high speed and avoid collisions and accident, and coordinate with hundreds of different cars on the road traveling on the same path simultaneously. We can form a software for that, but we cannot really form a software or code a program that could recognize patterns being formed in a stock market on a real-time basis and enter, or at least suggest trades, the entry points and exit points to profit from these trends. So that can give you some idea about how difficult recognizing those patterns and profiting from those could be. In fact, they are so versatile that even in case of efficient market hypothesis, and you would remember your basics from market theory, market infrastructure, efficient market hypothesis states that in case of strong market hypothesis, you cannot make extra normal profits for a longer period of time. So you do not have, fund managers do not have a positive alpha. These are the markets. This is the proposition which suggests that it doesn't make sense to invest in mutual funds, but you would rather invest in ETFs, right, or in indices which have minimal fund management fee, because on a longer term you cannot beat the indices or the market anyway. You cannot generate positive alpha, so there's no point giving fund management fee to the fund manager, and you are better investing in the broader markets. That's the strong efficient market hypothesis. There is weak efficient market hypothesis which states that you can profit from some insider information or by beating the market in terms of gathering the information, but that advantage does not remain under efficient market hypothesis. We have multiple markets which are close to efficient market hypothesis. I don't think there is any truly strong efficient market that exists, but we have many markets, especially in US, in London, in Singapore, which are close to strong efficient markets. But even in those markets, you can still profit from technical analysis. We have traders who rely solely on technical analysis to generate their profits, so that could give us some idea. And as I mentioned, it cannot be mechanized, computerized, or automized fully. There has to be human intervention. At least till now, the computers, the softwares have not evolved to a stage where they can create some strategies which are fully automated and computerized to be able to take benefits from the technical analysis, right? With these things in mind, let's head on to our content and start with the first chapter of the revised course.